It looks like we're going into 2026 with an extremely low IVR.
There's only risk on the table for me.
Home sellers right now outweigh home buyers by a significant margin.
The Fed doesn't control the long-term debt rates.
Trading at the monthly expirations has the tightest bid-ask spread typically and the highest volume.
Every bit of extra money you have, if you're not investing it, is just discretionary spending.
0 days have been my most profitable trade.
We still think the US has a big debt problem, and we're not just gonna let you off like this.
You have to be a little bit more careful, a little bit more paying attention to when that expiration is.
Let's talk about how you took a loss on them.
For me, that would be...
All right, cheers.
Cheers.
To another end of month, end of year episode.
Last episode of 2025. It was a wild year.
It was. We got a lot to talk about today, Greg.
We do. Tell us what we're talking about today.
All right, I'll tell you what we're talking about today.
All right.
Do we sound like we know what we're doing here? All right. So we do have a lot of, on a serious note, a lot of big topics to hit. Some really controversial ones, some kind of crazy ones that happen on Christmas Eve. So we're going to talk about a SPX trader, guru, coach of sorts. We've talked about him in the past. When I say in the past, I mean literally like 2 weeks ago. Well, you know, I was trying to, when we were talking about him, I was giving him kind of the benefit of the doubt, saying, well, he's been doing this for 3 years, his system's worked for 3 years, but it's extremely high risk, and we touched on that. Go check out that episode if you want to see it. But on Christmas Eve, hundreds and hundreds of people went broke listening to this guy doing his trade. So we'll touch on that. We're going to talk about the markets, GDP. GDP is surprising. Inflation is surprising. Markets are in a much different situation than what we expected. Low IVR, volatility in general, is very low. As predominantly option sellers, that's a pretty big deal. And I imagine the people want to know, what the hell are we doing? What are you guys doing? Are you guys trading? Are you placing trades on? So we're going to touch on that to give you guys a behind the trade.
Let's go.
Look at what we're doing. We're going to talk about some covered calls on Tesla that Greg just rolled out, and he managed them. We're going to talk about what he did, why he did it, the thought process. Again, the whole behind the trade philosophy here. He also closed out some leaps in Tesla Meta. We'll talk about the decision making that went into that. I got into a little back and forth with Senator from California, Ro Khanna. That kind of got a little
viral?
Yeah, a little attention.
Maybe.
And then we're going to end, which you guys should stick around for this because honestly, this is the most interesting part, in my opinion, our 2026 predictions. So we're going to have lots of interesting takes. And yeah, I'm excited, Greg.
All right. Should we start with the sad stuff?
Yeah, let's get that out of the way because that was kind of heartbreaking, especially given that we talked about it and we didn't expect this to happen, at least not like 2 weeks after we talked about it.
Well, let's back up here and kind of repeat a little bit what we talked about.
Sure.
So we had a colleague of ours pay for this course. He's somebody that trades with us. And he wants, as we all do, to continue to learn, to continue to grow, see how other people are making money in options. So he subscribed to this course and took the materials, understood the materials. And what it is it's one of those proprietary systems where they have this guru guy saying, tomorrow, trade at these levels, this number of contracts at these strike prices on SPX, the S&P 500, because this is what my guru black box secret formula says you should put your levels. And it's a system that uses something called the martingale strategy. And what that is it's doubling your bet every time you lose until you win. And so if you have a $50,000 account, you start, whatever, a $1,000 bet. If you lose, you double it plus a little extra. So then you're putting down $2,000. And you can see every time you double this, if you lose 3 or 4 or 5 times in a row, you get in a position where you could lose your entire portfolio. Now, this guru has been tracking the S&P 500, the 0 days, since they went to an everyday 0 DTE expiration date, which is only a few years of trading, I think since 2022. And he says, my system has never failed. Now, Nick and I both had some concerns about it. Nick, I think you tried it, gave it a shot. Maybe you want to tell us how that went?
Yeah, I mean, again, it worked. All right, so it did work. But I'm one of those people where I like to try something to truly understand the mechanics of it. And I think with a lot of you, if you're trading options, you know that it's hard to kind of paper trade options because there's so much that changes in the pricing dynamics throughout the whole trade, because it's not just supply and demand with options. But so I wanted to try it. So our friend, he told me essentially what was going on. I followed all the rules and I did it. And while I came out profitable, what I quickly realized, and I didn't need to do it to realize this, but what we don't like to do is trade big. We like to trade small. We like to trade often. And the reason we like to trade small is so that no one loss can really hurt you. That's the whole idea. Because with what we do, probabilistically, and we can see this in, right, you got probability statistics, which you see, it's like, okay, that's theoretical. And then you got your true returns, your true statistics. And our statistics actually tend to come out better than what the theoretical statistics are. And this goes back to why implied volatility tends to be overstated, et cetera. Right. But I digress. We tend to have a 90+% win rate on our trades. That means we're going to have around a 10% loss rate. And when those losses happen, we expect them to happen, but we want them to be small, manageable, and we want to take them quickly. But with this other system, it encourages you almost to keep more than doubling up. Because if it doesn't work on day one, then on day two, you need to go bigger to compensate for the loss from the previous day and to hopefully eke out a little bit of a profit. And then if you have a loss then the next day, you go even bigger. You have to make up what you lost the last 2 days. And then on top of that, you try to put a little more so you can eke out a bigger one. And I try to give him the benefit of the doubt because he does talk about a few things. Like, he does say, don't use everything. He says, allocate a certain percentage of your portfolio. But that's like 50%, 65%. We're not talking about, like 1 or 2% like we talk about.
Right.
We're talking about big chunks. And I want to give him the benefit of the doubt because he has all the stats there. Every single time they place trades, how it has always worked out. It's never gone beyond a level 6, I think is what they have. And it's worked out. So I give him the benefit of the doubt. I was like, hey, it worked out for me, even though we got to level 5. And I was like, I was talking to our friend, like, I don't like this. This is too uncomfortable. We have way too many contracts. We're at 30 plus contracts at that point. Like, this is insane to be holding this overnight at such close strikes. Anyway, so it worked out, but you could feel the risk that was here. You could feel the ticking time bomb of what it is. And I don't know, maybe you can now tell people like what happened.
Yeah, so Christmas Eve, we get a notification from our buddy that took the course. He has access to the Discord channel where the guru will post the levels that you should trade at. And in the morning, he messaged us and showed us the messages, the Discord, showing that they were at level 7, which means everybody had bet a substantial amount of their portfolio because they had doubled down put level 1 on, doubled down to level 2, doubled down to level 3, doubled down to level 4, and they're losing each time. Just
because Greg didn't go through the system, so he doesn't know all the mechanics. So what they do is they start at level 3 and they work up from there. And whenever this happened, it was actually a level 6 that blew up, and it had never gotten to a level 6 other than like maybe like 2 other times in the last 3 years. So sorry.
Yeah,
I just want to make sure that if anyone comes at us,
right,
we are accurate.
Good clarification. I didn't take the course. I'm hearing secondhand. I was privy to the Discord messages, but not how the system fully works. So we start seeing our buddy starts texting us images from this Discord chat, with the scariest one being somebody said, thumbs up if it doesn't work out today, if you'll lose your entire portfolio. And 99 people had thumbed up that post.
That was when he sent it.
Yeah.
If you looked at it later on, it was hundreds.
Oh. And so the trade didn't work out. And all those hundreds of people lost their entire portfolio, followed by, we got slews of messages from our buddy that was screenshotting everybody's response to it and how heartbroken they were. I think there was one woman that was planning on taking her family to a nice trip starting that day, and they called off the trip. They still went out to dinner, and keep in mind, this is Christmas Eve. So it is an absolute heartbreaker for these people, and our hearts absolutely go out to these people. And if anybody is listening that was a part of that system, if they want to talk, if they want to learn about other strategies, we'd encourage them to contact us. We'd be happy to talk to those people.
Yeah, and we talk about this not to be like what we do is better or anything like that. Look, at the end of the day, I'm not here to tell you what's better or not better, but we have a certain philosophy about trading small, trading often, so that you don't take that type of risk. We take enough risk already with what we do. I think everyone who's in the stock market in general takes enough risk that you don't need to amplify it in ways that can completely wipe you out. And so that was kind of really what we were honing in on. I mean, you were all about the martingale strategy that, you read some white papers on this being applied to option trading, how it doesn't work. But for me, it was more so, doing it firsthand, it was more so about, oh my goodness, you get so big when you do this. Like, that's extremely dangerous, because when does it end? How far can it go, right? The market can be more rational than you can stay solvent, right? So
the market can be stupid longer than you can be solvent, or it can be irrational. It can be irrational longer than you can be solvent. Yes. So that's why we even started talking about this. But this is not a listen to us, don't listen to them. Like, again, I do think that they have some good concepts that they talk about, especially with expected moves and all that. But I'm going to disagree with you there.
Okay.
I'm going to disagree with you when you said, we're not here to tell people that there's a right way and a wrong way to do it. I'm paraphrasing. You said something else. I absolutely think there's a right way to trade and a wrong way to trade. Now, there's a lot of approaches, but the wrong way to trade, in my opinion, is to push off the responsibility of learning how to trade, the ins and outs of options, the mechanics, the strategies, the risk management being most important, and how to defend when things are going against you. I think anybody that wants to trade options needs to put in the legwork and learn these things themselves, because paying somebody to tell you how to trade, I think, is the riskiest thing you can do. Our industry is full of these gurus, and I don't want to talk too badly about other people in the industry, but the financial markets have always been full of gurus that will say, give me your money, I'll show you what to do, I'll tell you where to trade, I promise you these amazing returns. And time again, it fails. And what people that often put on courses want to do is they want to make something proprietary so that they can say, come to me instead of coming to somebody else, because I have the secret formula. And that's not how it works in reality. The reality is there's no secret formula. There's a right way to do it, which is to learn the mechanics, learn the risk management, learn to defend. And I'm not going to promise you'll be a profitable trader. It takes the right mindset as well. But if you have the mindset and if you learn how it works, you can and will be a profitable trader.
I don't disagree with anything you said. I think I was just more so saying, like, we're not talking about it to put people down when they're already down.
No, yeah.
We're talking about this just because it happened to be something we talked about. We just got done with Christmas, and this happened on Christmas Eve. Our friend was part of it. So it was something that we couldn't not talk about.
Absolutely.
And so I just want to echo what Greg said. We do think that there's a proper way to trade, but the point of bringing this up was not to say, hey, go sign up for our course on January 31st if you want. No,
yeah.
I'm joking.
Plug. No.
Yeah. But it's not to say that, and it's not to put them down. It's something we talked about, something we have to address, something that we know about. And Yeah.
I also want to double click on something else that is important in this discussion, and it's to double click on the concept of trading small. And that is or I would say our biggest problem with the martingale strategy or any trading system that uses it, because we can't predict when the losers will come. Like Nick said, you're going to lose 5-10% of your trades, and that's okay. You're still going to be very profitable, but we can't predict when that's going to happen. Like, yeah, we can use momentum indicators and we can use what's going on in the market to get an edge, but we can't predict when things are going to go wrong. So when things go wrong, if that position is not small and your trading strategies are not diversified, you take the risk of that loss wiping you out. And that's why the most important thing at the end of the day is trading small.
Well said. Well, with that said, let's move on to maybe some happier topics. Yeah. So, Greg, the markets are in an interesting position. I know right now this is a very slow week with New Year's coming up, New Year's Eve, all that, right? So this will probably be a pretty slow week in general. And watch out for Tesla. We'll talk about that in a little bit. But GDP just came out. And GDP was way higher than expected, had a 4 handle versus a 3 handle. Inversely, inflation, CPI came out, and instead of having a 3 handle, it had a 2 handle. So as we go into 2026 and seeing what we have from the latest data, what, in this point in time, obviously, right before New Year's, what's your take on the markets? What do you think's going on? Where are we at?
Yeah, well, I think the GDP number surprised everybody, for one. The estimated GDP print for last quarter was 4.3%, instead of the projected 2.3% for last quarter. That was led by consumer spending. Kind of surprisingly, investments where it was flat to a little under what was expected. That surprised me a little bit, but the combination, in my opinion, of a growing GDP, which may or may not be led by things like the AI revolution, AI infrastructure spending, combined with lower than expected inflation, in my opinion, is setting us up for a fantastic 2026. I don't see, and you may disagree with me on this, but I don't see a lot of speed bumps going into 2026. And that makes me extremely excited for 2026 as a trader. Right now, we've got a low IVR environment, which I know we're going to talk about as well, which makes it a little bit difficult for us traders. But that's my opinion on going into 2026. I think it's going to start off strong.
So I think I actually, I thought a lot about this today. I'm not convinced that 2026 starts off strong. And I'll tell you why in a second. I do love seeing CPI come down. I do think we're going to continue to see this with inflation. And I do think we have a very strong economy when it comes to, if you look at it from a lens of GDP. I do think there's still an affordability issue. I don't attribute that personally to anything like tariffs or anything. Like, it's not because inflation is going crazy. We still have inflation, right? 2.7, that's still inflation. But things are at least calmed down, kind of back to normal as far as how fast prices are going up. However, people are still dealing with the persistent long high inflation that we had over the past 4 or 5 years. That is nothing to ignore, right? People have been able to take it on the chin, but there's a certain point where people get fatigued from extremely high prices, high groceries, going out to a restaurant, right? All these like little things start to add up. And I think that is starting to weigh on a lot of people in the everyday economy. But I think when it comes to businesses, I think the AI trade, as everyone's talked about, is booming right now. And I really don't think it's going to slow down anytime soon. And, we were talking about it right before we started recording. Right before we started recording, we were talking about how I get annoyed when people continue to say the same thing as far as the AI trade or GDP, saying the only reason GDP is up is because of all this AI spending on data centers and energy for data centers and chips. And it seems like a silly thing to say, because you can make that same argument for any other point in time. And it doesn't make sense to sit there and say, yeah, but, or if we exclude this, because it's the reality. The realities we're here. The reality is we're spending on these data centers, we're spending on these chips, we have to spend on electricity, all these construction workers are getting hired, cities are booming that have these data centers there. Yes, electricity prices are going higher because of that, but people are getting more jobs, there's higher paid jobs happening. And so I'm of the opinion that there's more jobs being created and growth happening with AI than all this supposed job loss that we're having. And every time people talk to me about all these job losses with AI, my question to them every single time is, okay, well, who's the biggest AI companies? NVDA, Microsoft, OpenAI,
Tesla,
Amazon, Tesla. Okay, can you show me, if these are the biggest AI companies, where are all the people they're laying off? Because if they're the biggest AI companies, aren't they the biggest beneficiator of AI?
right?
Wouldn't they be the first on the front line to know how to displace humans?
Mm-hmm.
So where are all those people getting laid off?
Yeah, I think that whole conversation is premature. The conversation of, are we going to have sustained job loss due to AI? I think that's years and years away. Something that I thought was kind of interesting that you said, how do you reconcile inflation being persistent with consumer spending rising in last quarter? The answer, I wonder, is, are consumers forced to spend more because of inflation? And that raises consumer spending in the GDP data. And then that GDP data is used to say, hey, the economy is doing well.
So there's a combination of the answers to that. It's not just one silver bullet.
Sure.
So one, we have seen wages going up at a higher rate than inflation has been occurring, right? Whether it's 3, 2.7, whatever. We've seen, I think right now, real wages are growing at 5 to 6%. So that's one. Two, credit cards, debt, right? People are taking out a lot of debt to sustain themselves. We're still seeing people pull out from savings, right? There's a lot happening there. So I think people are getting from different places. And then I also think the money that people would have allocated in the past for savings, whether that's to invest or to buy a house, they're foregoing that capital for today, to spend today. Because think about it, Greg, whenever you've bought a few properties, whenever you bought those properties, you had to save that money. You had to have a down payment. You had to have enough money for escrow. You had to make sure you could afford, the mortgage. You had to, you buy new furniture for that place, all this stuff. But if you see housing prices and interest rates and all that, you're like, that's not even in the game plan. Well, guess what? Every bit of extra money you have, if you're not investing it, is just discretionary spending.
Yeah, and that's consistent actually with another stat that I read recently, which is that home sellers right now outweigh home buyers by a significant margin. And at first when I read that, I was like, well, home buyers have been waiting for interest rates to come down. They've started to come down. There's more talk of them coming down. There was a little bit of hesitation or pessimism about whether the Fed would cut interest rates at the last chance they had, and they did. So that's positive. But that may be consistent with what you're saying here today, which is consumers are forced to spend. They're not saving as much. Ergo, they're also not able to save and spend on a house, purchasing a home. So that's an interesting.
Yeah, and for those who are listening, again, not to make this an econ class or anything, but the Fed doesn't control the long-term debt rates. They can only influence the short-term debt rates, right? So that's why we kind of look at the 10 years somewhat of a proxy. So that's all they can influence. And what's interesting is, despite all these rate cuts that we have seen the Fed do, the 30-year is only down something like 10 basis points. So it really hasn't budged much. So that kind of tells you that the bond market, the bond vigilantes are sitting there saying, well, we still think the U.S. has a big debt problem and we're not just going to let you off like this. And so I I do think they'll come down eventually, but I think it's going to take a little bit longer than, just like the market can be irrational longer than
You can be solvent.
Right? And I do think that when that does happen, it's not like you're going to have a flood of buyers. I think you have kind of buckets of potential buyers. I think first you have the bucket of people who are just waiting for rates to get down to 5%. And those people are sitting there waiting to go, and they'll be ready. But then you're gonna have other people who are also waiting, but they haven't been saving or they don't have the capital. And once rates get to somewhat of a good place, we're like, okay, well, maybe it can make sense to buy a house now. Well, then they have to start saving up for it. And they have to figure that out. Maybe they have to get an extra loan. Maybe they have to ask their parents for help, or maybe they just have to wait and save. So I don't think this narrative of once rates are down, there's gonna be a flood of people is gonna happen. And the third bucket on that would be there's gonna be a group of people that don't want to buy because they think rates are going to go lower and they're going to wait. So I think you kind of have this divided that it won't have a flood of people coming in. But I digress. I don't know how we got into housing. Let's talk about 2026 and what I said that I see some risks. Some you said that you didn't see a lot of bumps. Let me tell you the bumps I see.
All right.
Number one, for all Tesla investors out there, Tuesday. January 2nd. I think that's a Friday. I think so. Yeah, because that's expiration. So January 2nd is a Friday, and we're going to have Tesla delivery numbers. That is going to be a potential issue for Tesla if they're not good. And especially since right now the estimates, I think, are something like anywhere from 1.6 to 1.8, which would be 3 consecutive years of showing less total sales. Now, with that said, Tesla also has a couple other potential hiccups. We don't have the ZEV credits anymore, right? Those are canceled out. And sure, not for the entire world, but for the US, well, you might see a smaller of that. It might take time for those to go away, but that could be a hit for Tesla. And then I think Tesla also potentially has the issue of things being a little delayed. I think that could potentially weigh on the stock. So just want to be transparent that this next month, I think, is kind of a critical one for Tesla, and Tesla can hold up decently. I think Tesla will be fine for the rest of the year. The second thing that we really need to keep an eye out on is the end of January. The end of January, we have another government shutdown looming. So this last government shutdown didn't really affect the market too much. It started maybe, I think, end of October, but November was not a great month to trade. November, we both finished profitably, but November was a rocky month for the markets. And I wouldn't say it was all attributed to the shutdown. A lot of it had to do with OpenAI and Michael Burry and a lot of the drama that unfolded and consumed the AI world. But you can't discount that some of that was the government shutdown. So we'll see what happens there, but it's just another cautionary event to be aware of. And then the last one that I would say is any kind of bad CPI data that comes out. Honestly, at this point, this last GDP print was actually not great for Fed cutting rates. January predictions are now down to like 20-something% that they'll cut rates. So they're not cutting in January. In fact, I don't think we see another cut until the new Fed chairman gets nominated and takes over from Jerome Powell. So we'll see, and we should get the announcement on that maybe in the next couple of weeks on who that's going to be. And the last potential hiccup here for everybody is the Supreme Court ruling on tariffs. Whether Trump can keep them, whether he has to take them off, whether there's some kind of middle ground, we don't know. But it's something just to be aware of. So I don't think any of these things really rock the market in a bad way, but it's definitely going to stir up some volatility. So I think it's good to have capital on hand so you can deploy it when that volatility finally starts to tick up.
Yeah, and that, volatility is very low right now. And it's been very low for a while now. It looks like we're going into 2026 with an extremely low IVR. I would say extremely low IVR, but a very low IVR, and that affects how we trade as primarily option sellers. We're also option buyers when the situation warrants it. But what are you thinking going into 2026 with the low IVR environment? How is that affecting your trading?
Yeah, so I mean, I think, because we talked about this right before we got on here, but and we talk every day about what trades we have on, so you obviously know, but I have a lot of buying power right now.
Yeah,
a
me
lot.
too. But why?
So the idea is, I've got two points of view. Okay, so there's one where I'm scheming. I'll talk about that in a second. But then, just in general, mechanically, when volatility is low, I like to not have a lot of positions on. Mm-hmm. So I had positions on all throughout December. Right, December is gonna be a great month for me trading, great month for you trading, and I could have rolled a lot of those out to January, but volatility had contracted so much that there was only risk on the table for me. Because if I rolled it out, this is what volatility does. It shrinks, it expands. It shrinks and expands. The beauty for us as option sellers is that when it expands, not only can you trade wider, but premiums are juicier.
Right. So
you get paid more. And as we know, volatility, unlike stocks, always regress back to the mean, right? They always do this. Go up and down, up and down. This is my jellyfish hand. So
it's your spirit fingers?
My spirit fingers. I'm actually impressed. That was pretty good. So that's what it does. So when volatility is contracting or is as contracted as it is, I know that what's going to happen next is it's going to expand. Yeah. And so I don't want to get caught in that expansion where all of a sudden I get caught upside down on a trade. Right. So where I would normally, if everything's still good the way I like it, I would just roll the trade out, take profits, roll it to the next month. I've just been closing out. So that's the reason why I don't have a lot of trades on, why I have a lot of buying power. But I told you I'm scheming. Mm-hmm. Part of my scheming is that I have lived through the last 5 years seeing there be at some point at the start of the year where you could have taken huge advantage of one of these stupid, silly pullbacks are for no reason. Whether it was when Russia invaded Ukraine and the market dumped, whether it was obviously the tariff announcement, whether it was, I don't remember what the other ones were, but literally for the last 5 years, it's always been a moment where it's like, man, I really wish I had capital to deploy.
Something in the first quarter of the year that, whether it's an invasion, whether it's tariffs, something like that,
seems to always come up.
Right.
And for those who are going to nitpick, I get it. The April news was not technically first quarter, but it still lived within that ballpark at the start of the year. So I just want to have a little extra capital on hand too, to potentially take advantage. And, knowing me, I'll see a 5% pullback and be like, this is it. This is my moment. And then it'll go profitable for like 2 seconds and then we'll drop another 10%. And I'll be sitting there like, oh no. So, but that's kind of what I'm thinking. So one, just in general, our mechanics, the way we trade, we sell predominantly options. We buy with companies that we have huge conviction on, that we want to own the stock, that we believe in. And when volatility is low, we also like to load up on those from a buying perspective. But I want to go into 2026 with an open mind and a lot ready to deploy. But with that said, today I did do a little deployment. I sold a strangle on Meta. I believe you did too a few hours later. We have different expirations on that. I went where my expiration was January 30th. So it would.
That's a great topic to talk about. Sorry, go ahead. That's a great topic to talk about.
All right, we'll spend 2 minutes and we'll go on to the next thing here. But I sold I think it's 740 call, and I sold a 595 put on Meta expiring January 30th. Why did I do those? That's a 18 delta on the put side and a 15 delta on the call side. It paid me about $6,000, $6,500. And I chose those strikes because it's outside the expected move. I like the deltas. I like the probabilities. I think it's like a 89, 92% probability of winning. But expiration date was January 30th. I chose that because I wanted to make sure I was not going to go through earnings. Because I believe, I don't have empirical evidence other than just my own experience, but I believe that if you go through earnings, earnings can become a anchor to keep a lot of premium stuck in the options rather than allowing it to decay. And so I like to avoid that. And so by having it expire on January 30th, there is no earnings effect on the options. So that was my thinking.
That's really interesting. And this takes us back to the previous episode where I talked about my Lululemon trade and how I inadvertently went through earnings.
Oops.
Whoopsies. It wasn't a big deal. I survived. I still had a very profitable month. But it's an interesting problem that arises here because there's expiration dates that are daily, weekly, and monthly. And trading at the monthly expirations has the tightest bid-ask spread typically and the highest volume, which is related to having a tight bid-ask spread. So if you sell in the monthly, you're going to get a better price for your sold options.
Correct.
But you take the risk of going through earnings. So I did a similar trade to Nick on Meta today, but I chose the monthly expiration that was just after earnings. And so it's kind of you put yourself in a situation where, like, yes, you get a little bit of a better entry, but you take the risk of going through earnings. Now, the reason why I'm okay doing that is because what I like to do as I get about 10 days, 2 weeks before my contracts expire, or really before earnings, I will take one side off and then the other side off as those two become profitable. So you can do it either way. The way I decided to do it today, you have to be a little bit more careful, a little bit more paying attention to when that expiration is so that you don't get caught in the situation that I got caught with the Lululemon trade.
I hope he doesn't make the same mistake twice.
And we'll find out in a month. We'll talk about it, I'm sure.
Yeah. End of or beginning of February. Title of that YouTube episode: Greg does it again.
Meta gone wrong.
Yeah, meta gone wrong. Oh, that's good. All right, maybe he'll have to take a loss intentionally.
All right, I don't know about that.
All right, so let's talk about your covered calls. On Tesla, and let's talk about how you took a loss on them so you can make more money on them.
Yeah.
And so maybe you could talk about why you decided to roll your call, or maybe just briefly talk about what it means to roll, why you rolled it, and why you're willing to take a 7K loss to make more money.
Yeah. So I'm a big Tesla investor, as are you. Big. Real big. And
we do everything big.
Grant Cardone, we're 10X. I like to have covered, I talk all the time about my pillars of competency. These are not the things that I'm good at versus the things I'm not good at. These are the trading strategies that I like to keep in my head because that I do all the time if the market conditions warrant. For me, that would be typical bread and butter 45-day trades, selling options, covered calls, leaps when the situation dictates it, and SPX 0-day trades. Quick plug to, we will be putting together a 0-day SPX course that will be live at some point. But so we're in a low IVR environment, but Tesla still has really good premium, as it often does. So I've got these covered calls on Tesla. They're decaying in value. That's called theta decay, right? They're decaying in value. And those were set at 485. I've been in them for a while. Tesla went up above my strike price, so I'm in the money. Oh no, I'm losing money. I'm down 20 grand on these, right? That's a bad thing. No, it's not a bad thing, is it? It's not a bad thing. And the reason it's not a bad thing is because my cost basis in Tesla shares are much, much lower. So what am I getting for these covered calls, right? I keep all the premium that I received. It was about 20 grand. and I keep all the appreciation up to 485. These contracts were expiring January 16th, whatever that monthly expiration was. So yeah, I went in the money, but I'm going to make money on the shares. I'm going to make money on the premium. You can't lose with covered calls. But what happened 2 or 3 days ago, the stock price decreased a little bit. I went out of the money, and that gave me an opportunity to roll those covered calls out later in time and go wider. So I was able to go out to February 20th. I was able to roll them out to 550.
What do you mean when you say roll?
Right. You raise a really good point here, because rolling can be kind of confusing. Rolling is nothing more than closing one position and opening up a second position in the same underlying in one transaction.
And I'll say, I've never actually said it this way, but the other reason why it's beneficial to roll is because when you did that, you took a loss.
Yeah.
Right? You took a $7,000 loss. But when you roll, it does the math for you. And I think that's the other benefit of rolling, is that you took that $7,000 loss. When you roll, it'll show you the credit you can receive, and that credit you receive accounts for covering that loss already.
Right.
And how much you'll make in total in the next trade. And so you would not have done this if you couldn't have received even more money. But it made sense to take that 7K loss to make even more money. So
right. So now I rolled it out in time. I took a artificial 7,000 loss, but collected additional premium. So now my premium that I've collected for now they're rolled to February 20th, 550 covered calls is something like 25, 30 grand. I did that yesterday.
And that 25, 30 grand is after accounting for that 7K loss, just to be clear.
Correct.
So at first he could make 20 grand, right? He could make 20 grand. Then he said, hey, I could take a 7K loss now, but after I account for that 7K loss, I'll still make another 25, 30 grand. So really you add that 7K loss to that for your true numbers, if you want to see it as a whole. But from break even, he would make another 25, 30 grand on top of that.
Exactly.
Math makes sense.
And that's the beauty of covered calls. You can roll out further and further as you get closer to that expiration. As the theta decays and the price of that option erodes, you're keeping that premium difference, which I was doing there. And so now I've got these 550 covered calls. But what happened today? Tesla stock price goes down about 2.5%. I don't know what it's at now. We're filming mid stock market session. So I rolled them down today. So I rolled them out yesterday. I rolled them back down today to 530 and collected $9,000 in profit. So I took the $7,000 paper loss yesterday and rolled them down and took a $9,000 win today. So that's how you can use covered calls to make income on your existing positions in a very, very safe manner. You can't lose on covered calls.
So we're sitting at 463 right now on Tesla. So yeah, that worked out really well. I will say you can lose on covered calls if you decide to shoot yourself in the foot. If you decide to literally do the most dumb, idiotic move ever. The only way you can lose on a covered call, Greg, is if the individual decides to do something stupid. And stupid is as stupid does. Someone said that once. I think his name was Forrest Gump. And the reason you can do something stupid is, let's say right now, let's say you all sold a covered call for $530. Right now, I guarantee every single one of you would sell me your shares for $530 when the stock's at 463 right now. You would. You all would. Especially if I told you I was going to pay you 30 grand for it. And what that means is, hey, if it goes up to 530, you get all the appreciation up to 530, and on top of that, I'm going to give you 30 grand. You would all take that. None of you wouldn't. If you wouldn't, you're not mathing right. I don't know how else to say it. But what happens is people do that, and today they say, brilliant, I'll take that all day. And then it'll be expiration January 16th, and it'll be January 7th. And all of a sudden, Tesla's at 525. And all of a sudden, people are freaking out, like, oh no, my shares are going to get taken away from me. And what if we're going to go to the moon? We're going to we're going to $700. I'm going to miss out on everything. No, you're not. No, you're not. And people will decide to go ahead and close out of their covered calls, and it'll take a big loss that they didn't have to take because they're emotionally tied to their stock.
Right.
And so what I would tell people is you can hurt yourself with covered calls, but only by being emotional, having FOMO. That's the only way. And so don't sell covered calls if you truly cannot separate your emotions from the stock. I'm not telling you to not have emotions when you trade or you invest. That's impossible. We're all humans. We're all going to get excited. We're all going to get upset. We're all going to get scared. We're going to have all kinds of feeling. A lot of times this happens all within the same hour. But what I'm telling you to do is stay mechanical. You can be emotional, but stay mechanical. So if you stay mechanical, you're not going to hurt yourself. The worst case scenario, that does happen. Tesla goes to 540, goes to 560. Well, guess what? One, your break even's above 530 because I paid you an extra 30 grand. So your break even's actually way higher than that. But you can just buy the stock back. It's not the end of the world. Like, go for it. You missed out on a few bucks. Or you could just sell puts to potentially buy it back and pocket more money. Tesla, we know, goes up and down just like every other stock. And so I don't think that there's going to be a point in time where we're just going to go up by $200 in a month and everyone's going to be like, oh, I missed out. I think those days are behind us. Tesla's too big of a company. Now, I will say you can be smart about when you sell covered calls. You know, maybe don't sell covered calls before a big event for Tesla. Maybe don't do it before an earnings call because you never know what can happen. You know, avoid those moments, and most importantly, do it when volatility is high, which is, you know, a lot of what we teach. So I think those are, you know, some of the strategies that you can employ. And again, two other things, like that's what our options crash course really talks about and what we teach. We teach you how to know when to sell, when to buy, how the mechanics work. So we actually have a course coming up on January 31st. Unlike the gurus and all those, the idea of these courses is that you come, you join, and we teach you how to fish. Whereas everyone else is trying to be the restaurant where you have to keep coming back to eat. We want to teach you how to go hunt for the fish, know how to fillet the fish, know how to cook the fish, know how to teach other people how to fish. That's the goal. So you should not come back to us for anything else unless you're going for another course that we're doing that is separate from the options crash course, for example.
On a different topic.
Exactly, on a different topic, like the 0 days. 0 day trading is a whole different world, but leverages all the concepts from the crash course. Greg has been working on this. I know he, you know, just kind of plugged it a little bit, but Greg's been working on this for the past month. And a lot of you who've taken the crash course are probably sitting there thinking to yourself, what the hell, Nick? You told us to stay away from 0 days. You told us not to touch them. I did, because you probably weren't ready for them. But we have spent the last year doing them. And we have made enough mistakes where you guys won't make mistakes, or you shouldn't make mistakes. We have learned a system that works really, really well. In fact, Greg, I think you were saying that half of all your profits this year came from 0 days?
Yeah, well, I was saying my 0 days have been my most profitable trade of 2025. But I would echo what you're saying, that it is definitely an advanced strategy. You really need to know what you're doing, because with a 45-day trade, which is our bread and butter, you have 45 days to make decisions. Something starts moving against you, you have time to make a decision. We have a trading group of 3 friends that all trade together. And when we're in a situation where something's moving against us in a 45-day trade, I'll give Nick a call and say, hey, listen, this is what's going on. You know, I'm down this percentage. Maybe this news came out. I've got this many days till expiration. And Nick will say, well, can you roll it out? Can you roll down the other side, the untested side, which is something we teach in our crash course. You can talk about different ways to manage.
Or I mean, I think most recently I told you on a trade, like, great, just take the loss. You're up $50,000 for the month. Just take the loss.
Exactly.
Like, who cares? Like, get rid of this problem child.
Exactly. But you don't get that opportunity in SPX on 0 days. And the reason is because you're in the trade for a mere matter of hours and things can move quickly against you. So you have to have a very ingrained set of mechanics on what to do in every situation to be profitable. SPX is, it's you're placing where we place very safe trades, and we probably have a 97% win rate on SPX. But on those 3 to 5% of trades where things go wrong, you have to know what to do. And the reality is those 3 to 5% of trades, if you're following the mechanics, you're not going to be in harm's way. The profit generated from those other 95% of trades well covers any type of loss, in my experience, in our experience of doing SPX trades. But my point here is, I totally agree with you, telling people, hey, listen, this is an advanced strategy. You got to know what's going on before you try it. Otherwise, you can certainly lose a lot of money doing it. So
yeah, and there's levels to it, right? With like the 0 days, you need to be by your computer. You need to be there. Whereas what we teach in the option crash course, again, January 31st, go sign up. What we teach there, you should look at your computer, a couple times a day, but you're not stuck on the computer. The only reason you're stuck at a computer is if some freak event happens, right? Which is uncontrollable, like some black swan event, or, you just made something stupid and you weren't mechanical. But other than that, I mean, we'll just look at it on our phone here and there. Just, it's really, I don't want to say it's hands off and requires no work, but it's pretty hands off and it moves really slow. Whereas the 0 day, you need to be around. Now, the beauty of the 0 day too, though, is a lot of times in the first 30 minutes to 1 hour, you won the trade.
Right.
And you can go about your day.
Yeah, once you see the direction of the market, you can be pretty confident. The other huge advantage, I know you talk about a lot of SPX trades, 0 day trades, is you have no overnight risk.
Yes.
So overnight risk, after the market closes, you'll have earnings, you'll have news, maybe you'll have jobs numbers pre-market, or you'll have Fed interest rate decisions, all kinds of black swan events that can cause markets to move rapidly. And so you don't take on any of that risk in our system of 0 day trades.
Yeah. I mean, with everything, there's a risk and reward. And so the idea is to stack advantages in your favor. So, but yeah, so guys, look out for that. The 0 day course, that's, I want to have it live by February. So we can do that. I know a lot of people have reached out to me about that. It's not something I've been really talking too much about, but we'll be more public about it here soon. As soon as we know that the course is locked up. And going back to what you're talking about having a group. So I did a options course, crash course, on December 20th, right? Great turnout. All of you, thank you for joining. But yesterday, one of the attendees, Sherry, reached out to JoJo, these two ladies, and Sherry asked JoJo, hey, we should exchange numbers so we can, talk, and we're going, it's like exactly.
I love that.
Right?
I love that.
I literally hearted as like, I love this. This is exactly what I told you guys to do. And that's why we say women and people who are more kind of on the technical side just tend to be more mechanical and tend to be a lot better at trading. I mean, anyone can do it, but they tend to be the ones that I see have more, I don't know, they're just more stable for some reason.
Yeah. We should maybe think about facilitating a way that people that take the course can get together and form their own trading groups. Because one of the most beneficial steps that we took as traders is to do it together. We have a group of 3 guys. We get together at the end of every month. We talk about how we did, what mistakes we made, how our profit was, lessons that we learned. And that probably has had more of an impact on my trading strategy and my success than anything else. Oh. So maybe we should think about, maybe we should have a free Discord, not something we're like, trying to make money off people, just a way that people can connect. Maybe it's a Facebook group, maybe it's something like that.
So it's interesting you bring this up. Tomorrow, for anyone who's subscribed to me on X, I'm doing a private spaces for them. So we're all going to be on there tomorrow. I think it's at 3 p.m. Eastern. So if you guys are subscribed to me, remember that tomorrow at 3 p.m. But yeah, I like the idea to maybe do it a little more broader. That'd be good.
Yeah, it's just a way for people to talk.
So with that said, Greg, let's touch quickly because we got Rokana to talk about and we got the predictions. Guys, stick around for the predictions. This is going to be fun. Talk about why you closed out your leaps on Tesla and Meta.
Yeah, so I mentioned my pillars of competence, and one of them are buying leaps and high conviction stocks. But you want to do that when IVR is very low. And the reason why you do that when IVR is low, one, it means there's not a lot of fear in that particular underlying that particular stock or the market in general. And so IVR was low on both Meta and Tesla about a month or two ago. And this was actually an idea that Nick gave me. He was like, hey, shout out to Nick. Sometimes he has some good ideas. He was like, maybe we use some momentum indicators to indicate where the stock may be going that we teach about in our course as well. Everything was lining up for those two underlyings to buy some leaps. The setup was there. So I bought those, and I had about, a few days ago, I had about a 30% profit on both of them. And even though the indicators, the technical momentum indicators said stay in these leap trades, I decided to close them out. It wasn't technically the right thing to do. It was really more of an emotional thing to do. It was more of a treating trading like a business thing to do, because we're coming up on the end of the year. I'm having a great year. I know you're having a great year, but I wanted to end the year on a high note. And there's something to be said for that. There's two things to be said for that. One is ending the month or ending the year on a high note. Don't take outside risks at the end of the month if you're calculating your profit on month-by-month basis. Don't take outsized risks when you're keeping track, when you're trying to treat trading as a business at the end of the year. So it was primarily that reason that I decided I'm going to close these trades. And it worked out.
Nice. Well, congrats. I can't wait to see how your month ends.
I think I'm looking about $55,000, $60,000 a month again.
It's beautiful. That's beautiful.
Yeah.
Well, I'm a little bit behind you, but yeah. It's beautiful. We'll unveil, as we always do at the end of the month. We'll publish our P&L and
live
our
on X.
Win rate. Yep.
Not live.
Well,
not
yeah.
live on X.
And I will say that's something that we do that's a little different than a lot of people, is that we will publish our P&L, whether it's winners or losers, and we show our win rates on our trades. I mean, we designed a whole interface just so we could capture this, so we can share it publicly, so you guys don't think we're full of it.
You can see the number of trades we did, the average profit per win, average loss per loss, metrics like that can help maybe other people decide how many trades they should be putting on, or whether their win rates match up to other people that are trading.
Exactly. All right, well, let's talk about a little drama, and then we'll get into our predictions.
All right.
So, Greg, I picked a fight this past couple days.
You did. With
Rokana. He is advocating for a billionaire wealth tax. I'm adamantly against it. I had a lot of back and forth with Rokana, except he just kept saying thank you and shifting the goalpost, putting burden of evidence on me. And even when I would give him the evidence, he still kept dodging. And honestly, all of you and the entire X universe really piled on him. And it really, honestly, I don't know if he's going to win re-election after this. It's not just me. I started that. And then David Freeberg came on, then Chamath came on, then Jason came on, and then what's his name? Atkin came on.
Bill Ackman.
Yeah, Bill Ackman. And Joe Lonsdale came on, one of the founders of Palantir, and just everyone is rallying against him now for not because he wants to tax billionaires more. And that's what I think some of the criticism of my post, people call me a bootlicker, people call me a grifter. One person's calling me a grifter because we teach you how to sell options. Like, oh, you're just a grifter. And it's like, you don't even know what we're doing here.
Right.
Like literally most of the people who take our course, they pay it back within 2 trades. You know, like, and I publicly share that with people. So I want to explain just briefly why Ro Khanna is just missing the point and why I care. I don't care because I feel bad if Chamath has to pay more taxes. I don't care about that. I don't care if Elon has to pay more taxes. That's not why. The reason I care is because we're doing 2 things. One, we're telling government, hey, you don't need to be responsible. You don't need to balance your budget. You don't need to live within your means. Instead, you can always go and tax us more. And this country is based on no taxes. This country is based on, if anything, tariffs or no taxation without representation. And so the government has not shown an ability to be good stewards of the money that we give them. That's number one. So we need to have the government show us that we can be good stewards of your tax money before we ever increase any more taxes. So that's number one. But number 2 is our entrepreneurship, our tech leaders, our American can-do attitude is the golden goose that you don't want to F with. You don't. All right? If we start taxing them on their wealth, if we start taxing startups on their wealth, if we start, even though I don't like them, people like Sam Altman, if we start taxing him on his wealth, things are going to happen. Number one, you're going to have what's happened. California's a microcosm. What happened there? You have Peter Thiel leaving. You have Jason left. You have Elon left.
Joe Rogan left.
Joe Rogan left. I mean, you go on and on. HP left. SpaceX left. Tesla left. I mean, literally, it's an exodus out of California. And it's not just because of the wealth tax, but California's pushing people out with this type of philosophy, this type of worldview. So that's one thing. But 2, if we expand that nationwide, what's to say that these companies don't say, all right, we're going to be out of here. Another country is going to sit there and say, come to us. We won't tax
Dubai?
you. Yeah, literally, there's so many other countries right now that people could go to. So if we lose our entrepreneurs, if we lose what makes this country great, which is not the government, it's our businesses, which are built by the entrepreneurs of the world, the brightest of the world come here to build, we are in trouble. So it's not about sitting here and saying, Chamath, I don't want you to pay, or I don't want you to pay more in taxes. Like, oh, let me bootlick you. It's nothing to do with that. It's that I know how the system works. I understand how our economy works. I understand that we all get the benefit from them taking on extraordinary risk. It panned out. And guess what? Yes, they got outside reward, but now all of us get the benefit. All of you got the benefit from Tesla without having to lift a single wrench at Tesla. All of you got the benefit because Elon took the risk. Elon took everything from PayPal and put it into SpaceX and Tesla. All of you got the benefit because Jensen started his business, worked out of a Denny's until NVDA became what it was. All of you got the benefit from all these different companies because these people took risk. And so to sit there and disincentivize or give reason for people to start their businesses or take their businesses outside of the country, you don't want to do that. Delaware's suffering that right now because of what they did to Elon with his pay package. California's seen an exodus. We don't want this to move to a nation issue. And so that is why I'm so passionate about this.
Yeah, and I'd add a wrinkle to that, which is we're talking about billionaires, but we're talking about capital allocators. What are capital allocators? They're people, entities, or governments that spend money, that allocate capital for services, products, functions. Who would you rather have as a capital allocator? Do you want the government or private individuals or companies that are providing goods and services? What they're doing is they're trying to shift capital allocation from people and entities that are really good at allocating capital to the government, which is really poor at allocating capital. And that's not a good thing for anybody. I mean, we're sitting here, we got our iPads, we've got our mics. All these things are provided by people and companies that allocate capital and provide high-paying jobs. Just look at Tesla. Tesla is the largest manufacturer of vehicles in the United States, right? They employ 120,000 people in the United States. Good, high-paying jobs. They pay more than the Fords and the Chevys because all those manufacturing are overseas. They left. Why? Because it got too expensive. Why? Because of taxes. Because, and so I think that it's a really poor way to think about it of these billionaires, they don't need this money. Let's take it from them and let's give it to the government who can then allocate the capital. And the reason why that's poor thinking is because these individuals and companies are not outsized consumers. They're not purchasing all the avocados in the world and throwing them in a big dumpster so you can't get avocados. That's not what they're doing with their money. They're not buying up all the houses and keeping it away from everybody, right? They're not over consuming. They just have a lot of capital that they can allocate to productive and useful endeavors.
And it's not like their capital sitting in cash either.
Exactly.
It's ownership of business. Like I mentioned Sam Altman. Right now, OpenAI is a private company. If he had to pay a tax on his wealth, the market would know that he is a forced seller.
A distressed seller.
Seller. And the market is going to reward him accordingly by receiving his or offering him money for his share in the companies at a discounted price because they know that he's in a tight spot. That's not good. Furthermore, we don't want to force our founders to have to offload ownership of their companies. The best companies in this country are still owner operated.
Absolutely.
Google now has their founders back. You can see OpenAI, whatever you think of Sam Altman, he's still there. You got Elon, you got Jensen, Michael Dell is still running Dell. I mean, you can go on and on. These founders are still there, right? And these are the best run companies in the world. So I think that and I love to see the pushback, Greg, that everyone's coming up with because it needs to be had. We need to have this pushback because without them, we are going to screw this country up. You know what the worst part is? Go ahead. Take every single last time from all these billionaires. All of them. Take it all. You won't even be able to fund the country for half a year.
Right.
It's this misnomer. People think that one, they have all this cash just sitting there in the bank account. And two, they think that the billionaires aren't paying their fair share. It's like, don't you get it? Even if you took everything they have and you distribute to everyone, or you just took it for the government, one's going to get squandered. I mean, just look at Minnesota, what's happening there. But two, you still would not even get through a whole year of spending. So it doesn't work. What we need is to have government be accountable, and we need government to balance the frickin' budget and to prove to us that they're good stewards of our capital.
Yeah, I'm gonna say the term to use with Ro Khanna is he got ratioed on X.
Not by me alone, but across the board.
By you,
yes.
the all-in guys.
Yeah.
So many people.
All right, now, hopefully, if you're still here, the moment you've all been waiting for.
Wait, I want to say one other thing, which is I sent this to you on X earlier today.
Giving everyone blue balls right now.
I know. I don't know. I made a cupping motion. But did you see I sent you a video of Ro Khanna talking about why a wealth tax does not make sense from like 2020?
Oh, that's hilarious.
Yeah.
No, what did he say?
He said exactly what we're saying right now.
Get out of here.
It stifles innovation. He gave the example of you wouldn't want somebody, a startup founder that raises capital. This guy, he's a startup founder, is taking no salary. He's living with 3 people in a basement, whatever. They raise money, say they'd raise $1 billion, and he has a 20% stake. or let's say he raised $5 billion and he has a 20% stake. Okay, now this founder is worth on paper $1 billion. If you were then to tax him 5% of his wealth, he doesn't have $200 million sitting around. He's living in his mom's basement. He's just started a very successful seed funded company, but it hasn't even recognized revenue yet, right? Yeah. This happens all the time. So he was talking about how it stifles innovation. And now so I think when he's talking to you on X and he's not answering the questions, he knows both sides of the argument. He knows exactly what he's doing. I think there's forces behind him that are saying, hey, if you don't make this push, California, we're all making this push, all the politicians. If you don't push this, we're not going to support you in some future campaign or something like that.
Well, the other thing too, though, and I promise we're getting to the predictions, is that what he does is he tries to hide behind, like what they've been doing is using healthcare. That's what they're using. They're trying to tax on people's empathy. And they're saying, oh, you billionaires, you wouldn't mind paying extra 1% tax a year for 5 years to help give better healthcare. That's what he says. So he tries to make people look bad. But the truth is, no. Let's just be honest. No, I wouldn't. Because I know how you guys work. The Affordable Care Act, apparently not affordable. You guys couldn't even fund a train to go from, what was it, Palo Alto, wherever, San Francisco
LA
down
to Fresno or something like that.
Yeah, you spent like what, some amount of billions of dollars. You got like nothing done.
Get like 5 miles of railway.
So no, the truth is, it's not that they're not willing to pay it or they're not willing to give for healthcare. Is that you're just not the right medium to do it. Period. That's number one. But number two, at the end of the day, I would rather see that money in the hands of Jeff Bezos, because Jeff Bezos is going to go from Amazon to AWS to Blue Origin, and Elon Musk, who's going to go from PayPal to SpaceX to Tesla, the Boring Company, on, to a Peter Thiel, who'll go from PayPal to Palantir. Like, these are the people that I would rather give the capital to, not to government. Government has proved no good at using resources at all. So, anyways, I'm passionate about this.
All right, on to our
now the moment you've all been waiting for. The moment that if we have even one person still on, we thank you. And just don't forget to like and subscribe. We're just two dudes with black shirts talking about trading and hoping that one day we can show you what we do and you sign up for our course so that we can teach you how to fish. And then you can teach your kids or your family how to fish. And we can all be more financially savvy.
Right.
With that said, Greg, welcome to the predictions of 2026 on Behind the Trade podcast, sponsored by nobody. All right, question number one. What or who will be 2026 the biggest political winner? Dun, dun, dun.
I'm going with Scott Bessent.
Ooh, Scott Bessent, Treasury Secretary. Do tell us more.
Oh, yeah. So Scott Bessent is, like you said, U.S. Treasury Secretary. He has just been calling everything right lately. He called right that tariffs would be a boom on the economy. That has been shown so far, right? Despite everybody around him saying tariffs are just another tax on the consumer. He was on the All In podcast recently. He pointed to a Stanford study. Stanford is a very left-leaning organization. He is a Trump appointee, so he's on the right side. So this is not information that is designed artificially to support his opinion.
And he's a former Democrat.
He's a former Democrat,
just to be clear.
Former Soros hedge fund manager, Democrat, turned Republican, now in the Trump administration. But he pointed to a study showing that tariffs are a boom to the economy, are actually deflationary instead of inflationary. That has shown to be right. We saw that in the inflation print this last quarter. He is also a supporter of the Trump savings account for kids. Absolutely love that, right? We want to see these kids be invested in our economy. That's something that is a concern for many people, is that young people are not investing in the economy because assets are growing, home prices are so expensive, and that can be extremely detrimental to the fabric of society, as you and I have talked about before. And he's also a huge fan of deregulation, which I am as well.
I love that. And shout out to Brad Gerstner for being the brainchild behind the Trump Accounts, America Accounts, what it was originally called, and Ted Cruz for helping get it as part of the Big Beautiful Bill. So I like that. It was a great one.
Well, let me ask you, what is your biggest political winner of 2026? Apologies.
So today, at the end of December, just before New Year's, this is kind of a contrarian take, but I'm going to say the Republican Party and DJT, and it's obviously contrarian right now because polls don't like them right now. Looks like they're going to lose midterms. That's the way everything's shaking out. But I think in 2026, with them focusing now on affordability, with them, it seems like the Ukraine-Russia war is about to potentially come to an end. Seems like we're right there once again. It's hard for me to think that Trump will not do everything he can to make sure that they win Congress again.
I think he just lost half our audience there by saying Trump is your 2026 biggest political winner.
Hey, I mean, he was 2024's biggest political winner, right? He was the biggest comeback kid of all time. So, but hear me out. Affordability is on top of everybody's mind, right? And shout out to Democrats, because Democrats are the reason why that's on top of everybody's mind, because that's kind of been the calling card that they've been using now to attack Trump. And Trump's really good at saying, understanding kind of the 90-10 issues and adopting the 90% of it. And now he's saying affordability. He cares about affordability now. So now 2026 is going to be about that. But he knows that if he doesn't get that dealt with before, say, September, October, and the elections are in November, his presidency is essentially over. He's going to be stuck. He's going to have no Congress because it's going to be divided government, and he's not going to get a lot done. So he needs to win the midterms. And I think if the Republicans win the midterms, I have 2026 as the Republican Party as being the biggest political winner. So It's a big contrarian call, but that's where I'm at.
All right. I like it.
All right. Now for this next one. Greg, who or what will be 2026 biggest political loser?
So I just told you that you lost half our audience by saying DJT is the biggest political winner, but I'm about to lose them as well. I'm going to say Tim Walz in Minnesota are 2026 biggest political loser. The fraud. So I don't know if you saw this, but Nick Shirley, this guy named Nick Shirley, a YouTuber, put out this YouTube video that is absolutely viral on X, showing the amount of fraud in the Somali community in Minnesota. Tim Walz's state is the governor of Minnesota. And it is staggering. It's heartbreaking. It's really highlights the level of fraud that is in Minnesota and probably other places. When you take that and you combine that with his kind of downfall from the presidential run, especially when he's standing on stage celebrating Tesla at $220 a share and tanking, he did something like this. When Tesla is one of the Mag 7 companies supporting the entire economy, right? We've got everybody's retirement funds that are affected by Tesla stock price. It was such a bad look for him. So I think he's going to be our biggest political loser. I think he is going to fade into obscurity in 2026. I don't know if you saw this. I saw a clip today. I can't verify this, but somebody said they verified this on X. One of the phone numbers listed on one of those Minnesota children healthcare facilities that are fraudulent, the phone number on the sign goes to Tim Walz's governor's office.
I saw that. I was about to bring that up to you.
Okay. Somebody said they verified it. We should verify it. We should call it live on camera.
We should.
Now.
Actually,
Just kidding. Let's not do that.
Okay. So I actually have the same political loser.
Okay.
So we won't be long in the tooth there. I agree with you. I think what's happening there is crazy. And I think going from being the potential VP just less than a year ago, or I guess a little more than a year ago now because the election was November 5th, but just over a year ago, he was potentially our next VP to what's happening now. And if you look at Polymarket, there's something like a 60% chance that he gets federally prosecuted. I don't know if you can go any other way than him being the biggest loser.
Yeah. All right. Well, let me ask you the next question, which is who or what will be the biggest business winner in 2026?
Who or what? I think that in 2026, the biggest business winner will be SpaceX.
Dude,
and
I was going to say that. You took my answer.
Well, hey, great minds. And as a result, Elon Musk.
All right.
So SpaceX is speculated to, and essentially confirmed by Elon to be trying to go public in 2026. It will likely be anywhere from a $900 billion to $1.5 trillion company IPO, the biggest in history. And so Elon will probably become the world's first trillionaire in 2026. And for Elon, even to compound it, anything extra that happens with Tesla will just be, cherry on top of that. And with that said, Greg, it's interesting. While we're here, Tesla just broke under 460, so that's interesting. But again, low volume in these markets, but it's just something interesting. Your covered calls are probably doing pretty good right now.
Yeah, well, yeah.
Sign up for January 31st. You're like, I don't know what to say.
Might have a better month than expected here, guys. I don't know. I'm going to add a wrinkle to that.
Wrinkle it up.
I'm going to wrinkle it up. I don't know if this will happen. I don't think you think this is going to happen, but Elon tweeted I apologize. He X-posted. We got to get a better name for that.
Just post.
He posted, following a post by, I think, Bill Ackman, that Tesla shareholders, if SpaceX goes public, should get warrants for shares at a set price. That would be a great boon for Tesla shareholders, for SpaceX. They're going to be very similar shareholders. They already are very similar shareholders. Options traders, because we love the high premium in Tesla.
Sorry to interrupt you. Yeah. I know what they're going to do. I just realized what they're going to do.
Okay.
Drink this bourbon. It will help you come up with ideas. So Elon a while ago said that Tesla investors, early investors, will be rewarded. I don't think that they can offer to all early Tesla investors. I think that'd get too messy. But I think what they'll do is, as part of the IPO, right before everyday people can get in on it, I think Tesla is going to be one of the initial IPO investors. And that's how everyone will benefit, and that will keep it nice and clean.
Yeah, you need board approval, I think. You would need a shareholder vote for that.
I don't think you would need a shareholder vote.
No, because we needed a shareholder vote for investing in XAI.
That, I forget why, but I think that was a little different. But yeah, anyways, I think that's what they do. That's my theory.
Well, let's keep it moving here. Who will be the biggest business loser of 2026?
Okay, so you guys already know my bias, so I'll just say it. OpenAI. I have OpenAI is the biggest loser. It's not anything to do with my opinions of Sam Altman, although I think he's not the most ethical person. I think he doesn't pass the gut check. But I have OpenAI because it seems to me that there's a issue with their current evaluation levels and them being able to raise capital. So right now, if they want to raise more capital, they're going to have a higher valuation. And I think they're getting way over their skis. So that's why there's been a lot of this talk about them IPOing. On top of that, they have deals with Oracle for data centers. Oracle is essentially getting declined and shown as too risky from Blue Owl, who's the private funder for Oracle and the data centers. And so this whole it's just getting kind of messy and convoluted. On top of that, you have companies that OpenAI is going against and working against, like XAI, like Amazon, like Microsoft, like Google, who have other revenue profit generating arms that they could essentially self-fund should they desire, or they have more ability to raise money in the debt markets, capital markets, than what OpenAI will. So that allows them to continue to march ahead of OpenAI. And furthermore, Gemini, Grok, Anthropic within their niche of the enterprise space, they all seem to have passed OpenAI now. And honestly, ChatGPT 5, from everything I've read, everything I've heard, not just trying to rely on my own bias, was kind of a flop. So I think OpenAI will continue to move slow, deteriorate, have bad reputation, have issues raising capital. And I think that's what happens when you go against Elon.
Yeah, I think they kind of have that first mover. There's a first mover advantage, but there's a first mover disadvantage as well, which is you've told people what can be done. Now everybody's going to jump into it, right? And so,
and to that point, MySpace, look what happened.
They may be the MySpace of 2026.
Netscape, look what happened. Blockbuster. I mean, like you can go on and on. Like these companies, just because you're the first mover. I mean, even Microsoft. Did you know that Microsoft had a touchscreen phone before Apple did? Did you know that the first tablet was actually made by Microsoft, not by Apple? So you see this over and over where the first mover, even electric vehicles. GM had an electric vehicle, right? We all know about that documentary. But they had an EV way before Tesla did, before Tesla was even a thought. So, yeah, OpenAI.
OpenAI, that's your answer. All right. Well, let me tell you about my biggest business loser of 2026.
I think he's feeling it, guys.
This is going to be contrarian.
Okay.
I'm going with Netflix.
I don't like it.
Option traders are like, I don't like it. The premium is juicy in Netflix. I've been trading Netflix all year long.
Have you traded it since the stock split?
No, I haven't traded it in a bit.
I feel like the premium's not what it was, or maybe it's just going to take me a little bit to get used to it.
Yeah, I've been staying out of it for a few reasons. The reason currently is they have made a bid, or they have made an offer that was, I believe, accepted for Warner Brothers and HBO Max. Now that would be a huge deal because HBO's content is fantastic. Warner Brothers has a very diverse and popular set of content. But what happened recently? So they bid for to purchase Warner Brothers. It was, I believe, accepted. I even, as a Netflix subscriber, got an email saying, you've heard that we just purchased Warner Brothers and HBO Max. Don't worry, your subscription won't change as we figure things out, yada, yada. And then 2 days later, you hear that Paramount makes a competing bid, I think because there was anti-monopoly concerns about Netflix purchasing HBO and Warner Brothers, which is fair. And that Paramount's bid is higher than Netflix. So as options traders, I would caution all of you, be very careful. If Netflix does not win this bid, it may cause high volatility in Netflix. So I would not be in Netflix right now. I would wait until Netflix is settled. It will result probably in high volatility, which will then be a pretty good time to get into Netflix as an option seller.
So you've been wrinkling me all day on this podcast. Let me give you a wrinkle.
Okay.
I don't agree. I think that any risk there is already being priced in, and the stock didn't really move too much up or down when the announcement was made or when all this drama right now unfolded. But Netflix is still the streaming platform around the world, and they're starting to get into the podcast space. So I find that very interesting that they're getting into the podcast space, and I think that could be a huge boon for them. Kill Tony is now on Netflix, so that's interesting, right? That's them leaning into that space. And I think I watch more podcast type content than I do normal TV. So I think that could be a really good space for Netflix, and that eats into what I would consider is the YouTube monopoly. And YouTube is way bigger than Netflix. So I think Netflix has a lot of TAM they can go after. And if this Warner Brothers thing doesn't work out, I think they'll be fine.
Oh, I think they'll be fine too. I would just be concerned as an option seller if you've got a strangle on there. Either side could be breached based on how that deal shakes out.
All right. So Netflix is yours. Let's see. What's next? Greg, in 2026, what is your most contrarian belief?
All right, you ready for this one?
I'm ready.
Hold on to your seat. Crypto fails. Bitcoin fails.
And you said I lost half our audience.
All right, here's my argument, right? Here's my argument. Crypto and Bitcoin is based on a public-private key that authenticates transactions called SHA-256. What it does is it turns every segment of code into a 256-bit password that, if anything is changed in the content, that changes the 256-bit code, and then you know that the data has been manipulated. SHA-256 has been the standard for encrypting data for a long time now, but supercomputers are getting to the point, from what I hear from pretty reputable sources, where it could possibly breach 256. Now, my concern here is if there is even a rumor that SHA-256 is breached, that's going to cause crypto to tank. That's going to cause Bitcoin to tank. And so I was talking on Christmas, I was talking to my uncle that is super successful guy in this space, super successful. He started a company that did Wi-Fi mesh routers before Arrow, sold it to Qualcomm. He's an inventor, has like 100 patents. He's litigated those patents. He's sold those patents. He's a serial inventor. We were talking about this over Christmas, and his opinion was that SHA-256 could be cracked. And when it is cracked, there's even a rumor of it being cracked, Bitcoin's going to crash. Now, let me preface that by saying, this is not a preface because I'm saying it after, let me follow that up with, I have never been a big believer in Bitcoin. It has zero, in my opinion, intrinsic value. I won't go into my whole spiel of why I think Bitcoin is not a great investment, but that is my pick for most contrarian belief heading into 2026.
Can I steel man quickly the other side?
Yeah.
If I was anyone listening to this right now and you're a big Bitcoin investor, my thought, and I don't expect you to rebut this because I don't think there is a rebuttal, it's just we'll see what happens, would be if SHA-256 gets hacked through quantum computing, then this is not just going to affect Bitcoin on an island. It's going to affect all of banking systems, all of identification, literally everything we have in the world that's encrypted heavily uses SHA-256. It is the global standard. So while yes, Bitcoin would be impacted, so would the dollar, so would every other currency, so would every bank. So this would not be isolated to Bitcoin. And you are showing your inherent bias, Greg, by picking on Bitcoin and not mentioning all these other companies and all these other assets that would also be the beneficiary of this chaos.
Now, here's my rebuttal to that. Not that it's well thought out.
Here's the lawyer.
My rebuttal to that is, yes, every financial institution relies on SHA-256, but they have other safeguards in place. Not only that, Bitcoin is publicly traded. All you need is the rumor that there is a supercomputer out there that can crack 256, and Bitcoin price is going to start to slip. Once it starts to slip, it's going to be an avalanche of people selling because they don't want that risk, right? Banking systems are going to say, no, don't worry about it. We've got these other things in place. We've got, even if 256 is cracked, you'll be fine. We have the most sophisticated financial institutions in the world. We'll be fine. So I think just the rumor is all it takes for Bitcoin price to start slipping.
My last rebuttal, and then we can move on because that's my turn. I have more fun ones than Greg has for contrarian points of view. There is a system set up right now. I don't know off the top of my head where Bitcoin and the blockchain it runs on is set to move off of SHA-256 to the next evolution for encryption. So that is actively happening right now through all of the distributed servers. So we'll see what happens. But you're saying 2026. I call Fugazi on that. I don't think any of that happens 2026. I think all the quantum stuff is going to come in 2026 the same way as Tesla was going to have robo-taxis in 2021. We all thought it. We were all wrong.
Nick is just trying to win your favor. He doesn't believe that.
I won't with my next contrarian.
All right, tell us what your contrarian belief of 2026 is.
All right, let me make you all hate me once again. All right, take a sip of your drinks. Okay, I got a few here, okay? Number one, everything, especially because I know a lot of you are like us and you're obsessed with Tesla, you're obsessed with Elon, and let's be honest, we're all fanboys. But we must remain thoughtful and we must remain pragmatic. I believe that everything that all of you, everybody thinks is going to happen here at the start of 2026, whether it's January, February, March, June, July, August. I don't think any of it happens with robotaxis, FSD. I don't think any of it happens towards the last quarter of the year. I'm not saying that we won't go into a new city. I'm not saying they won't do another little expansion. But as far as everybody gets hands-free, or not hands-free, but gets to have unsupervised FSD, where we have robotaxis and more than 50%, covering more than 50% of the population, where we have hundreds of thousands of robotaxis, where we have over 100,000 cybercabs. I don't think any of that happens, even chance happening, unless it's at the very end of 2026. I think there's a lot of work to be done, and Optimus, I don't think we see really anything meaningful with Optimus until 2027. Not saying we won't see good demos where they'll show us stuff in the factory, but I don't think we see volume production or mass scale or Optimus doing actual jobs at Tesla or SpaceX that aren't more so demos than actual utility. So that's number one.
I think you did lose the audience on that.
I did. I know I did. Number two, I think the Republicans will retain Congress. And number three, I think housing rebounds this spring and summer. All right. I think housing is going to see a decent, I'm not saying it's going to be 2022 boom, but I think housing has a nice recovery this spring and summer. So those are my contrarian beliefs going into 2026.
All right, I like them. I mean, if incomes are rising faster than inflation, I think that could be a real possibility, especially with interest rates coming down. So we'll see. I'd love to see that happen. I
also think it's not just that. I mean, that's obviously part of just like several variables that go into this, but I also think a lot of it is the sellers don't need to sell. Right. And I think that is going to, we're already seeing a lot of housing being taken off the market. So I think there's a nice soft spot there where you're not going to see, everyone wants a housing crash. Everyone thinks there's going to be a housing crash. That tells me there's going to be no housing crash. Right? The same way we've been talking about recession for how long, and there's no recession. So I'm of the opinion that whenever everyone thinks something's going to happen, it's probably not going to happen. So I don't think we have a recession. I don't think we have a housing crash. And I do think the Republicans will hold Congress. Again, these are contrarian ideas. I get that, but I can also substantiate them. So that's where I'm at.
All right. Love it.
What's next?
What will be the best performing asset of 2026?
Okay. Best performing asset. So we're going to unpack this like a Russian nesting doll.
All right.
Equities. I think equities will be the best performing asset in general in 2026. That is also some of a contrarian idea because we saw that literally the past couple of years, 20% plus on the S&P. Maybe you wouldn't call that the best performing asset because gold has ripped, Bitcoin ripped, right? So we saw lots of things happen in 2024, but I think equities will continue to outperform. If I drill down more into that where it can be usable for everybody, I think the Mag 7 will continue to outpace despite everyone thinking it can't. Everyone keeps thinking, oh, well, it's the Mag 7 and the rest of the 93, or the rest of the 493. I'm of the opinion that the Mag 7 continues to crush it. And if I had to drill down even deeper, I think NVIDIA is the biggest opportunity right now. I think they're the cheapest Mag 7 company out there right now. They're the only AI company out there printing profits like crazy, and they have insatiable demand for what they sell. And there's no number two to them right now. So I think NVIDIA continues to crush it. I think NVIDIA goes to 300 by the end of the year.
All right.
That's a huge call. That's a 33% increase.
Yeah.
More than 33%.
Well, you heard it here first.
Greg, I got a question for you.
Yeah.
In 2026, what do you think is the best performing asset?
This podcast.
So hit the like button, hit the subscribe button. Don't make Greg a liar, and don't forget to sign up for our crash course on January 31st.
No, I'm going to say Tesla. And I know you may not disagree with me, but you also said the Mag 7 and equities are going to be the best performing assets. All right. So here's my reasons.
All right, I want numbers.
I'm not going to give you numbers. I'm not one of those guys that says my price target for Tesla is X number of dollars. But like, who says that?
What do you hope for?
What do I hope for? I mean, as high as it can go. But here's what I will say. In my opinion, Tesla is at a breaking point. We have the robotaxi network online in Austin and San Francisco Bay Area, expanding very, very quickly. I think that's very exciting. We have them starting to take the safety passengers, whatever they call those, out of the cars. We have FSD 14.2.2 that is absolutely crushing it. I drove from Tampa to the East Coast of Florida with my fiance over Christmas, and it's gotten to a point where it's sentient. I intrinsically trust it. Whenever it puts on the blinker to get in the left lane or the right lane, I used to look back to make sure there's not a car coming. I don't even do that anymore. Don't tell anybody about this, but
we'll keep this between us.
We'll keep it between us. We put the iPad on the dashboard of my Cybertruck and played Netflix the entire time we were driving from the 3 hours from Tampa to the East Coast of Florida. Not recommended. This podcast is not financial advice. It's also not safety advice. Don't sue us. All right. But you take that, you combine that with Gigapack revenue exploding. I think they're growing like 50% year over year. And people are recognizing the importance of it. What just happened in San Francisco last week?
The brownout?
Had a blackout. They had a brownout. San Francisco and California has rolling blackouts because they can't handle their power consumption needs, and they can't handle the wind gusts that they have through the valley. Yeah. So you can see how these gigapacks are extremely helpful for power line stabilization, for lower cost power, because you can charge them up at night when power demands are low and then use them during the day. We're seeing that growth. So I think Tesla is going to be the best performing asset of 2026.
I think people are wondering, what were you watching?
What? Sorry, then?
What were you watching?
What was I watching? Oh, on Netflix. I was like, way past that.
What conversation is this?
I don't know. We are watching Landman right now. Have you guys seen Landman? It is phenomenal.
We got rid of Netflix. So.
And Fallout Season 2, phenomenal, guys. Go watch.
All right. Well, Tesla's down to 458, so we'll see if you're right.
Exactly. The lower it goes before January 1st, the more room it has to run for me to be right in 2026.
No, that's That's logic. I don't know if it's sound, but it's logic.
It's some kind of logic. All right, let me ask you the next one here. What will be the worst performing asset of 2026?
I have here the auto OEMs. Ford, General Motors, Volkswagen. I think, I don't know if I have to go too much into detail with this, but I think you guys all kind of get it.
Yeah.
We see what's happening with Tesla. We see what's that the OEMs are pulling back. We see that they're struggling. I think this is the year where we actually start to see them break.
Okay. All right. Yeah. I mean, I know that that Ford stopped producing the F-150 Lightning.
Correct.
Which was, it seemed like it was a success. It seemed like it was going to be the Tesla killer that's been prophesized for about 10 years now. But that doesn't seem to have happened, huh?
Once again, another one bites the dust.
The experts are wrong. Is that what you're telling me?
Yeah.
Oh, wow.
Yeah.
The experts are wrong a lot.
Especially the famous, take that, Elon Musk. I don't know if you remember that, Jim Farley, but...
Oh, yeah. No, I don't remember
if
that.
you know, you know. So same question to you, Greg. What is the worst performing asset in 2026?
Well, I'm going to continue the haterade on Bitcoin here. And I'm going to say my haterade and say MicroStrategy.
Okay.
All right. So
that's a good one.
Here's my argument. MicroStrategy is or was a software company. They made some sort of software that contributed a little bit to their balance sheet, but primarily their balance sheet is composed of Bitcoin. The price of MicroStrategy should be at a discount from the trading price of Bitcoin because they're a publicly traded company that has CEO compensation, regulatory costs, employment costs, building costs, etc. So that should cause them to be trading lower than the price of Bitcoin. They've been trading higher than the price of Bitcoin, particularly about a year ago. In the last year, they've gone from, I think, the 300s a share down to, I think, they're about 160 now. And I'm going to say they're going to continue to suffer in 2026 and will be the worst performing asset of 2026. As taking it back, just talk to our options traders here. I'd be very careful about MicroStrategy. It's a highly volatile stock that tends to have great premium, has less so than it used to about a year ago. You and I used to trade MicroStrategy in its heyday, but I'd be careful. I'd be careful of this one, especially on the put side.
Yeah, back then it was, it was like at 300, 400, and you could sell calls all the way out 900 naked.
I almost did. Remember that?
You almost did?
Yeah, I told you. I was like, hey,
I did nonstop.
I was like, I could go out a year. A year from now, sell a leap on the call side, sell a leap for and collect like 80,000 in premium at like 900 a share, and you're like, dude, that could be really risky.
Yeah, I wouldn't do that.
Yeah, but it would have worked out great.
Yeah. But I was selling a lot at 900, 800 when it was at 3, 4. The premium was ridiculous. And that's definitely a ballsy call given that they're at like 52-week low. So. Hey, kudos to you. We'll see if he's right.
We'll see. All right, let me ask you the next one here. What is your most anticipated trend of 2026?
So in 2026, the most anticipated trend that I have is Gen Z and the fact that they are the largest church-going generation that we've seen in a long, long time. And I think this kind of supports a lot of my thesis about the Republican Party, becoming kind of the political winner, the Republican Party maintaining Congress in 2026. And I think seeing that there's such a big generation of Gen Z that, you pointed out to me the other day, they're drinking less, they're watching porn less, they're doing all these things less, and they're church going more. It's very interesting. And, I don't mean to say that everyone who goes to church votes Republican, but, you just see people with more traditional values tend to lean more to the Republican side of the aisle. So I think my contrarian take is what has historically been a demographic, meaning the young people, have been a more left-leaning populace. I think that we're going to see that flip on its head, and it's really going to start to show itself in 2026. And, rest in peace, Charlie Kirk, because I think we're going to see the fruits of his labor really come to fruition in 2026 like we've never seen.
You know, he really galvanized a big swath of the country.
Yeah, he gave people a chance to be heard and a chance to voice their objection and just listen. He never called anyone an idiot. He never pushed back on people in a petulant way. He challenged ideas and liked to be challenged. And, I think, there was only one Charlie. And I think he did things in the right way, in the respectful way.
So it's kind of funny. My most anticipated trend in 2026 is not the same answer, but it rhymes.
He's copying me, guys.
But it rhymes. So I'm saying my most anticipated trend of 2026 is authenticity. And that might not sound exactly like what you're saying, but here's what I mean by that. I think people are tired of influencers. They're tired of perfect Instagram posts. They're tired of, as hopefully we're learning, they're tired of gurus. They're tired of people saying, I have this secret formula. Trust me. No, people want real. They want, like you said, drinking is going down. They want stronger community. We're working from home. They want to bring people together. They want stronger community. They're tired of influencers. They're tired of fake guru courses. So I think if you can be authentic yourself in this environment, if you can be authentic on podcasts, if you can be authentic on trading strategies that work, that don't work, I think we're seeing a resurgence of people going to church, building community, traders helping traders. Shout out to Peter DiCarlo there. I think that's going to be the most anticipated trend of 2026, the podcast space, the trading space, across the board.
I like that, especially because I think it ties into what we're trying to do here. I mean, we're a new podcast. I get that. And I think a lot of podcasts probably start off with good intentions and then they deviate over time. But luckily you all benefit from knowing that we're not doing this for a profit. We're doing this because we're two guys that just want to talk with more people about these topics that we're interested in. And we grew up together, so we want to do something fun together. So we have no monetary motives for this. And even the courses, I think that's more, I mean, obviously we charge for it, but I feel like charity is the wrong word because we obviously charge for it, but it's not like we need it.
Right.
It's a passion project. It's a way for we can give back to people what we've learned. And I think with the way we approach this, like we said, we're trying to teach you how to fish, not trying to have you always have to come back to us. And I think there's something authentic about that. But also we talk ideally more about our losers or our mess ups, our fuck ups than we do worrying about, oh, look at us. We make every trade perfect because we don't. We screw up all the time. Greg screwed up a Lululemon the other day. I made a huge screw up in we both did, I guess, back in April, March. We want to talk about these things. And that's why we have our monthly meetings with us and our friend just to keep each other accountable. So,
going back to my previous answer, the other reason why we're doing this is to build community. No, because trading, particularly if you're an options seller, there's just not that many of them around.
It's lonely.
We happen to have 3 people that get together and talk about our trades every month, and we call each other. We have a group chat, all that, but most people don't. And we also want to hear how other people are trading. So part of this podcast is to build community with you guys, see how you're doing, what you guys are doing, what you guys are finding useful, and hopefully you can learn from us as well. So it's authenticity. It's building community.
And share your ideas with us, like Greg said. But keep in mind, this all started because I started trying to look into options, maybe like over 10 years ago. And once I kind of figured out a system that worked, I brought Junior and our other friend into it selfishly because I want to have this community you're talking about. I needed to talk to someone about it because my wife was going to do bad things to me, guys. All right.
As wonderful as she is, she's going to kill you if you keep talking about options.
I don't think she knew enough to be pretty dangerous with options. But I encourage you, if you're interested in these topics and you're passionate about it and you're constantly seeking more, go find your own friends. Go teach them, right? Like that's the whole point. I'm not even telling you to have them sign up for our course, because if you did our course, you should be able to go and teach them now, right? Go master, go learn together, go build together, and rinse and repeat. So I think, I love what you're saying about community.
So let me ask you, what is your most anticipated media trend of 2026?
I think in 2026, we're going to see a lot more Nick Shirley. Nick Shirley is the independent media YouTuber who is, whether he was the only one or there's others, he's the one that really cast the public light on what's happening in Minnesota. And I think we're going to see a lot more of that. I think we are already seeing that happen on YouTube. At least I get it in my feed. But I think this whole Minnesota episode is going to spawn, another 100, if not thousands, of Nick Shirleys. The same way where, the assassination of Charlie Kirk, I think that has, like people are saying, like, we're all Charlie now, kind of thing. So I think these things become kind of infectious, especially when you see good people doing the right thing and then they are tormented or broken down, or you just, there's something contagious about light, right? Light's like the ultimate disinfectant.
Right.
And I think people are drawn to that type of light. So I think we're going to see more Nick Shirleys out there. And I hope Nick Shirley continues to do what he's doing. He's gotten a lot of attention, spotlight, even before this Minnesota, fraud investigation video. And he's remained pretty humble, and he's remained, a normal guy, and doesn't seem like he's let any of the spotlight get to him. So hopefully he continues to do that, and hopefully he inspires more to do what he's doing.
Yeah.
Greg, what is your most anticipated media for 2026?
Well, I'm going to contradict what I said in my previous answer.
Oh, flip-flopper.
Which is, I think the most anticipated media trend of 2026 is going to be AI music. I don't know if you guys have heard some of these AI songs. Like they did a remix of a 50 Cent song, which one of his really famous ones, and it's fantastic. It is so good. But I also think there's a lot of creativity. There's a lot of authenticity in creating derivative works. I'm a patent attorney. The derivative work is a change on an original work to make it your own. But we have such the quality of both music and movies lately is so poor. One of my fiance's favorite songs is the song where the major lyric is, you turn me on like a light switch. And I'm like, that is the dumbest lyric I've ever heard. Like, please, like, use AI to remix Michael Jackson, right? Like some of those like great, like 50 Cent, Eminem, like whoever, not like all hip hop and rap, but I think the AI music is going to get out of control. It reminds me of that song by Roses by St. John, I think was the original artist. The song was, in my opinion, not super popular, but then this guy out of like Kazakhstan remixed it. It's called like the MNX remix or something like that. And it's like all over social media. And the song was just phenomenal. So I think that we're going to see more of that type of stuff in 2026. I'm looking forward to it.
Greg, can I tell you something?
Sure.
I don't think she was telling you that she actually loves that song. I think she was trying to send you a message.
Oh, wow. Message received.
All right. I like it. Okay. Let's go to our next one as we get into these last two. Stick around, two more. These are going to get a little more personal. Greg, in 2026, what is your biggest personal goal?
I have a lot of goals in 2026 personally. I proposed to my fiance in September.
Congrats.
You were around for that. Yeah, it was really exciting. We're getting married in Italy in 2026. Nick and I will be doing a podcast episode in Italy, hopefully. And
no hoping. We'll be live in Italy, or maybe not live, but we'll record in Italy. Beautiful background. We'll have the mics. We'll have some drinks, and yeah, we'll be sure that you guys are in attendance. If Chamath can record all in episode while he's at his wedding in Italy, so can we.
You know, Chamath, you're invited to our wedding. Show us how it's done.
Yeah. Feel free to take the rehearsal dinner.
Yeah, exactly. So we're getting married in Italy. We're planning on buying a house together in 2026, and maybe some family planning stuff in there too. Who knows? It could be a big year. So there's a lot personally going on in my world in 2026.
Sounds like there's gonna be a lot of light switching.
Maybe, but tell us what your biggest or one big personal goal of 2026 is for Nick Gibbs.
Yeah, for me, it would be, we have our son. My wife is still on maternity leave. And my goal for 2026 is to be able to officially retire my wife. Financially, it's not that. It's more so that she earns a really good income. And we like money coming in. We don't like money not coming in. But I think priorities are somewhat shifting. And we're getting to a point where, we've got enough going on where it makes more sense for her to take a step back and focus on, the child we brought into this world. And so, I think in 2026, from a personal level, it's going to be to allow her to go ahead and retire.
I love that. That's all our goals, right? As traders, we're here to change our lives, right?
Let's hope so.
That's good, doesn't it?
All right, last one for everybody. Greg, for 2026, what is your one big financial goal?
I have personal financial goals, but I'm going to say my big financial goal of 2026 is to help teach others to make money selling options and to be option traders, safe, effective, risk conscious options traders that can make solid income selling options just like we do. I think if we can impact lives in 2026 by teaching them how to do it safely, professionally, risk adversely, and we start getting messages saying, doing great. I'm making $5, $6, $7, $10, $20, $15,000 a month. I'm retiring my wife because of it. I think that will be for me, that would bring me so much joy.
I love that. Yeah. And I echo the same sentiment. I think for me in 2026, biggest financial goal is just from a performance perspective. I would like to increase my portfolio by 50% purely by trading. So not including asset. Yeah, exactly. I mean, it's hard to tell with owning shares, but maybe I should just say just in general increase by 50%. I don't really care how it gets there. But I think if we look back and we were able to correct some of the mistakes we did this year, I think it would have been feasible this year for both of us. Yep. And I think maybe it's not so much about the performance as much as proving to myself that we can iterate and learn from the mistakes and not make new mistakes and have a solid year where we are, we get to that 50%. Because really, if you just kind of tweak a couple different trades, we're right there. And so I think hitting that 50%, and it's not easy, and I don't want to force anything. I'd rather finish the year with a 30% than try to push for 50% and it blows up in my face. But I think finishing with a 50% increase in portfolio, that would be, I don't know, it would feel like we actually learn from our mistakes. And to me, I'm always trying to iterate and get better, and having a year over year change in that sense, I think that'd be profound. So it would show me that I can actually learn from my screw ups rather than just new screw ups always happening, because it's going to happen. But one of the biggest ones is, can we take losses even faster? Yep. Can we mitigate risk faster? Can we experiment? We did a lot of experimentation this last year. We did. A lot. And that's part of it. And I don't regret it because we learned a lot from it. but can we experiment a little less, stick with our pillars of competency, and that'd be fantastic.
Yeah, and I mean, we went through a lot this year. We had the tariff trades. We had a year of pretty high volatility compared to an average year. We learned some things about inverted strangles, different management techniques you try. Some of
futures,
them,
0 days.
That's right. So, it's traders are going to have losers, and that's normal. And it's a blessing in disguise because it teaches you to be really good traders. And what's amazing about that is despite experimentation, despite trying new things, despite the volatility that we had in March and April, we had incredible years. An incredible year, both of us.
Well, years. Yeah, you're right. And keep in mind, 2025, the drop that we saw in the S&P 500, around March, April, that is one of the fastest, most drastic drops that we've seen since COVID, before that 08, and then 1980. So, and obviously the .com. So people don't realize it, but 2025 was kind of a crazy year to start off with. And then it became smooth, but people forget.
Particularly as a Tesla investor.
Especially as a Tesla investor.
Right, so.
All right.
Well, thanks everybody for listening. If you made it all the way through, we appreciate it. We hope that you learned in this podcast, and we'll see you guys next week.
Actually, we'll see you next year. Talk to you later. Cheers.